This is Virginia Webinars. Thank you for joining us. Before we begin, I would just like to take a moment and introduce Virginia. If this is your first webinar with us, welcome. If this is not your first webinar and you have attended our previous webinars before, welcome back. I hope everyone is doing well. We at Virginia are a financial training and consulting firm. We were founded in Northern Virginia, right outside of Washington, D.C., hence where the name comes from. And we have a regional office here in the GCC based in Dubai. We are opening a new office in Riyadh. If the current situation / pandemic wasn't ongoing, we would already have our office there. However, we are still in process. We serve the US and the Middle East in terms of financial trainings. We offer trainings in everything from finance to data analytics to risk management, and also to leadership courses within leadership, such as the PMP or Project Management Professional Certification. We offer courses across all 4 verticals, from certification-based courses like the aforementioned PMP cert, the AFM1, courses within the ACCA such as Cert IFR and Cert IPSIS, and all of the Microsoft Office certification courses as well. We also have non-cert based courses such as Finance for Non-Finance, Financial Statement Analysis, various financial modeling courses, corporate valuation courses, data analytics, data Power Query, Power BI, advanced data analytics, and the list goes on. Please visit our website at viftraining.com to take a look at our full course catalog. We are currently offering most of our courses on a virtual platform. We also have course offerings in e-learnings, which are both with some in Arabic as well. So if you would prefer to take some of our courses in Arabic, such as an e-learning, they are available. Please again check out our website and please reach out to our main office if you have any interest there. So now let's bring it back to why we're all here. Let's talk about financial statement forecasting and highlight some of the rules of thumb that should be noted, I should say, if you're going to develop forecasts. Now, we will be looking at this mostly from a financial modeling perspective, because if you ask me and if you ask us at Virginia, creating financial forecasts is heavily reliant on your ability to create the appropriate financial models. Now, before we begin, let me introduce myself. My name is Farid Sadeh. I'm a consultant with Virginia. I cover courses within finance, investments, and data analytics. I hold the certification of the AFM1. That's the first level of the financial modeling from the Financial Modeling Institute. I also hold the Cert IFR from the ACCA, and I have a bachelor's and master's in finance. My bachelor's is from Virginia Tech, and my master's is from the American University in Washington, D.C. And I will clearly be the host of this webinar. Now, just a couple of housekeeping issues I would like to go over before we go ahead and begin discussing financial statements forecasting. This webinar is being recorded. You will receive a recording of the webinar, as well as the presentation and the Excel doc. We will be going over a case study in this webinar. You can rewatch this webinar at any time at our elearning.viftraining.com website. And in regards to questions, please send your questions as you as we progress with this webinar. I will try to answer them as we go. However, I will try to take them in batches every 10 or so minutes. Um, there, if there's any technical issues, please send it in the chat, send it to me privately, and I will try to resolve your issue as quickly as I can. If not, you will receive again, you will receive a copy of the recording so you can rewatch this webinar at any time. And as I mentioned, please visit our website at viftraining.com to check out the rest of our courses and our upcoming webinars. We will have a full slate for next year. I believe we have one more webinar this month to round out the year, so please check it out. If you are interested in anything within finance, accounting, data analytics, leadership, we do have our previously recorded webinars there. More specifically, if you're interested in anything within data analytics, such as Power BI, Power Query, I believe we've had webinars there. We've also had financial modeling webinars previously held, and the recordings are presented there. So let's go ahead and begin. Now, we are discussing financial statement forecasting. Now, before we can, highlight the key aspects of forecasting, let's just take a step back and understand, why do we forecast? Well, the simplest reason, or the simplest scenario in creating forecasts, is essentially for business planning. Whether you're a startup or you're trying to expand, every business needs to create a business plan, and business plans and forecasts go hand in hand. You can't forecast a business without understanding the business plan, because there are key variables within the business plan that the forecast needs to ascertain, right? Things like, especially related to high cost items like capital expenditures and large business expansions, right? So the other item is budgeting and forecasting. When a company creates a budget, that is essentially forecasting. Now, our financial statement forecasting are under all of these scenarios are reliant on the business plan. The forecasts are supposed to show you a different view of what the business plan is meant to do in a quantitative and numerical aspect. So if your business plan, the business plan, in terms of verbiage, includes expanding to new markets, well, the forecasts need to reflect that, meaning the appropriate costs need to be allocated and timed appropriately. So things like leasing new office space, maybe buying machinery and equipment, hiring new employees and workers. All of these things need to be taken into consideration when we create our forecasts. Missing any of these key assumptions can drastically and greatly throw off your forecasts from what they could be to the phrase, I'm just going to use the phrase garbage in, garbage out. But I think we can all understand that. I think we can all allude to, we can all realize that the forecasts are only as good as our assumptions. And our assumptions need to be tied to our business plan. Now, the other scenarios are more investment based. So things like raising capital, valuations, and capital allocation are all reasons to create financial forecasts, because the investor wants to get paid back, and the investor will always want to ensure that there will be a means for exit. So if we're going to talk about raising capital, let's just talk about debt really quickly. Whenever a business approaches a bank for additional financing, such as a raising of debt or a loan, the bank will analyze a company's financial statements and create financial forecasts. And those forecasts are going to be based on that business's business plan. So again, the two go hand in hand, and the bank will determine how much debt the business can actually take on and what level of debt the bank is comfortable in terms of lending. And it's the same thing regarding equity. Equity investors feel the same way. They want to ensure that they will see the appropriate return, and they will assess typically the cash flows using an IRR or NPV calculation to determine whether the investment in the business makes sense. Now, in terms of capital allocation, this doesn't only rely to portfolio management. As we all know, portfolio managers, investment managers heavily rely on capital allocation. Now, the same thought process is also relevant to the management of the firm. The management needs to appropriately allocate their capital, but also their resources in terms of what the business plan demands. And this allocation, this form of allocation, and where capital and resources have been allocated will be reflected in the business plan and the financial forecasts. So it all goes hand in hand again. Now, in terms of project assessment, this is pretty intuitive. Without the appropriate forecasts, we can't assess a project appropriately. In terms of evaluation, it's the same concept. In order to have the correct forecast, in order to determine an appropriate valuation for a business, the details, the assumptions included in the forecast need to make sense. They need to be in line with what the business expects or management believes they can achieve. And the same thing goes for an acquisition or sale. Now, we can create several types of forecasts, whether it's strategic, whether we're aiming for a strategic plan or an operational plan or a financial plan. But at the end of the day, all of these things do tie into the financial forecasts. And we want to be able to assess the forecasts results in something like this dashboard that we see here on our screen. This is a very detailed dashboard analyzing a business in many ways. As you can tell, you can see we have our assumptions at the top with a spinner, so we can either increase or decrease those rates. We have our ratios and our analysis on the right of it, and then we have some charts below. Now, this is a very good practice to have when you create forecasts. We won't be covering a dashboard exactly like this in this webinar. However, it really depends on the user base and what the forecasts are going to be used for. Now, regardless. Now, again, everything that you incorporate in your financial forecast will depend on the audience. So who will be using these financial forecasts? What will they be used for? Again, whether it's a valuation or whether it's a business plan or whether you're trying to allocate resources, the inputs will all, the key inputs, I should say, will be different. Now, we are going to cover the most commonly used or the most broad inputs, ones that will cover most situations that you would want to create forecasts under. However, this goes back to the basics of financial modeling. Every model is different, and at the end of the day, it really depends on what the model or the forecast or the business plan will be used for. So let's just talk about creating pro forma financial statements, because that's what we're going to be doing today. Our financial forecasts are essentially going to be the three financial statements. We're going to forecast the income statement, the balance sheet, and the cash flow statement. And we are going to go through the key items that most businesses have and the drivers behind those items. And we're going to try to interpret and highlight where you can get certain information and how certain calculations should be thought of. Now, in regards to revenue, since it is the most intuitive line item, there's several ways it can be calculated, and again, it's going to depend on your information available. So you can forecast revenue in a couple of ways: by applying a simple trend analysis, by using an average historical growth rate, some sort of regression analysis, or something like something like a more detailed breakdown by using specific assumptions for new products. For maybe management has actually highlighted certain units they expect to sell based on contracts or what have you. Um, but there are several ways to forecast revenue, for example. Now, revenue is in reality, revenue is the sales, I should say, is the driver behind every business. So this is the item that needs to be most carefully calculated, because this will drive the rest of the financial statements, meaning it will drive the rest of the financial forecast and the business plan and everything within. It all starts there. Now, coming up with the rest of your assumptions regarding interest expense, capital structure changes, any fixed asset expenditures, dividend payments, and working capital assumptions. That's going to be in the details of what the business plan is. Typically, when you create a business plan or when you're trying to create financial forecasts, the person or the analyst who's going to be constructing the financial model will need to sit with management. Now, if this is in your own firm, you will need to sit with your CFO, maybe your CEO as well, and you will need to determine you will need to interpret the strategic plan of what the business is going to try to achieve for the next year, 3 years, 5 years, however long your forecast is. You're going to have to determine if the forecasts you want to create are going to be monthly, quarterly, or annually. Now, I will tell you, creating forecasts that are anything but annually become much more difficult, because your calculations, your formulas will become reliant on the quarterly structure or the annual structure, and it becomes much less intuitive and more difficult in terms of making things line up appropriately. Now, the most simple forms of projections are annual projections. Now, this is because you won't include things like seasonality. In this part of the world, typically the Ramadan effect and the Eid effect, which basically, is essentially where business slows down regionally. And these aren't things you will have to take into consideration when you create annual financial statements. Now, if you're creating quarterly or monthly, even worse, monthly financial statements, all of these things will have to be included, and that can make the exercise much more difficult. So this is just something to keep in mind. Now, as I was saying, the analyst who's going to be constructing these financials and creating the actual financial forecasts will need to will need to first understand the business plan, understand what the main drivers of the business plan are for the next, however long, whether it's, let's just assume it is 5 years, and they will need to sit with management and really, really, really understand every single line item from the historical information moving forward, and basically figure out what the units sold are going to be when it comes to revenue, what the capital expenditures plan is for the next forecast period, and in terms of timing, in terms of costs, in terms of all of these high level assumptions, because these assumptions will greatly impact the results of the financial forecasts. Now, it will come back to everything comes back to what are the forecasts going to be used for. If it's going to be used for if it's an internal exercise, and it's just to create essentially a business plan or a budget plan for the next year or 5 years, then the assumptions will typically rely more on management. Now, if it's to get funding or to raise debt or equity, then the assumptions will most likely be sensitized by the other party. This is just something to keep in mind, because if you try to be too conservative in one instance versus another, then that can come back to bite you later. Now, for an internal exercise, being conservative is good, because you don't want to overshoot, and that can cause many more issues there. But when you share with an investor, when you share with a lender, being too conservative can bite you, but can come back to hurt you, because they might sensitize your figures downward as well. Now, this is just something to keep in mind, but I would like to take a step back and just talk about how you should structure your model. Now, essentially, you are constructing a financial model. Whether you are or you're not comfortable with financial modeling is one thing, but if you're going to create your financial forecasts, you will need to start thinking like a modeler, because the way the forecast is going to be constructed will be 100%. Will be constructed in the form of in a financial model. So let's just talk about the shell. There's going to be, when you construct financial forecasts, you should construct it in basically 3 categories. Okay, you should have your first category be your input sheets. This can include any and all of your assumptions, and as well as your scenarios sheet. Your scenarios sheet is essentially where you will be sensitizing your key assumptions. So if there is a range that causes so the scenario sheet is where you will sensitize your key assumptions. Now, your key assumptions are going to be those that will have the greatest impact on your business. For example, your sales growth, depending on how you are calculating sales, whether you're using a growth rate or you're using a units sold, this should be what is sensitized, because again, that will have the greatest impact on your financial forecasts. The other thing could be capital expenditures, depending on how much your capex will actually cost you. Another thing could be your margins. Maybe you want to sensitize your margins. Now, all of these things I'm naming will depend on how you construct your model. And the way you construct your model will, again, depend on what the situation is at hand. But now let's go back to our inputs. So these are the 2 main input sheets. The only thing you should keep in mind is all of the inputs for your model should be in the sheet. You don't want to have your inputs spread out over multiple sheets, because depending on how large this exercise is, it can make things very confusing. And eventually, if you try to delete something or replace something, you can break your model and you'll have to go back and start from scratch. And you don't want to do that. So a key here is to stay organized. The second area should be your calculation schedules. We believe that every schedule should be constructed on its own sheet. This just makes things clear and clean and easy to work through. And then you won't have any real overlapping between one schedule and another. Now, the other form of constructing a schedule, constructing your schedules or your working sheets, is to just have them all on one sheet and have them be constructed basically on top of each other. So essentially, it's in a vertical form where the revenue calculations are calculated first, and then below them are the cost calculations, and so on and so forth, until you complete all the schedules. Now, depending on your model and how large your forecasts are, how detailed your forecasts are going to be, that can work, that can be okay. However, we recommend at Virginia that you basically construct each schedule, each working sheet or each working schedule on its own sheet. This just makes things much easier and much cleaner. It will result in much less, many less errors, and there's a lot less room for error here. Now, the main schedules you want to construct, and these are pretty consistent regardless of what business you're looking at, are revenues, your operating costs. Now, these operating costs can be your cost of goods sold and your OPEX. These are different schedules and they should be treated as such. your working capital, your depreciation, which includes your capital expenditures, your income taxes, debt, and equity. These are the main schedules that you should be constructing usually. Now, there are other things that you can include, such as an end of service schedule, any other provisions you might want to include, and depending on your business, maybe you want to have a production schedule. So if, for example, you're selling, depending on what your business sells or what sort of service you provide, maybe you want to have a separate breakdown for revenue as well that includes volumes. Now this will, again, I'm going to say this again, it will depend on what the business is and how detailed you are actually getting. But now let's talk about the third area, and that is the output sheet. Your output sheets are essentially going to be your financial statements and your summary sheet. And that's it. Now, you can have additional sheets here, such as any sort of valuation sheet. If you're working on a merger acquisition, the merged entity sheets would be here, anything like that. But this will really be dependent on what the exercise you are creating will consist of. Now, the one thing I want to highlight is the calculation sheets should have no inputs on them. There should be no hard-coded figures on your calculation sheets whatsoever. These should be linked from your input sheets, and these should be essentially all calculations. This is where this is essentially where all of the work, or not all of the work, but I will say the most of the work, at least 3/4 of the work should be done here. The remaining being between your inputs and output sheets. Now, your output sheets should also have no inputs. These should be essentially direct linkings from the calculation sheets, and that's it. Because this is where you're creating your financial statements, and all of the line items on your financial statements should be linked from your calculation sheets. So let's just revisit the tab structures really quickly. So there's essentially, and I kind of highlighted this just a moment ago, but there's two forms of how you can construct your tab structures, and they can be constructed in a horizontal or vertical manner. Now, the horizontal manner puts each of your working schedules on their own sheets. The vertical approach puts the schedules on one sheet in a vertical fashion. So again, beginning with revenues and followed by your operating costs, your taxes, your working capital schedule, your CapEx schedule, and so on. Now, there are pros and cons of both. However, if you're working on a small model, the vertical approach can work very well, especially if it's a simple business and the schedules are not going to be too long or complex. However, if the business is large and complex, we highly recommend at Virginia that you that you follow the horizontal approach. Put every schedule on its own, especially if you're creating business plans, because typically that's why we forecast. But again, it is up to you. So just to revisit, we're going to be inputting. We are going to have an input section. We're going to model an income statement, a balance sheet, and a cash flow statement. And then we're going to apply some sort of scenario analysis on our forecasts. Now, our key inputs that I want to discuss are going to be our revenue growth, our costs our costs of sales, our OPEX assumptions, our any sort of provisioning policy, your working capital assumption days, planned versus maintenance CapEx, your debt schedule, and your dividend policy. Regarding revenue, there's a few ways that you can calculate revenue. Now, the calculations and the key inputs are essentially volumes versus price per unit. Now, price per unit should increase with a growth rate or inflation. Needs to be incorporated in the price, because as time goes on, you should expect to increase your prices. You don't expect to be paying, you don't expect to be selling your products for the same price now as you will be in 10 years, right? Your costs will be increasing at least by inflation, and if you keep your prices the same, you will be losing over the long run. Now, the second way to calculate revenue is to simply apply a growth rate. Now, this will depend on how much information you have on the business. If you are looking at a public company and you're trying to forecast those financial statements, the approach will be completely different. You will most likely not have access to all of the information like you would for a private business, where you're able to sit with the CFO or the CEO and get the appropriate figures for what projections will look like, for what assumptions in terms of pricing and units sold will look like. So those are the two ways that revenue can be calculated. Now, one thing to keep in mind are capacity constraints. You need to incorporate your capacity that can be applied to units sold. Every business has a certain amount of capacity that they can achieve, and it will be easier to get this information from from private businesses rather than from public companies. It will be nearly impossible unless the management has explicitly stated what the capacity constraints are. Now, something regarding capacity constraints, this should be tied to your capital expenditures. So if you plan to increase your capacity or your units sold beyond what is currently possible, regarding how much you're able to produce, this will be your capacity constraint. If you want to increase it, if you want to increase your units beyond this amount, you will need to make capital investments in your fixed assets in order to achieve this figure. This is just something to keep in mind. So as your revenues increase, your capital expenditures should be increasing at in a similar fashion, I want to say. Now, talking about our costs. Our costs are essentially split into two categories. Now, these are kept at high levels intentionally because every business is different, and depending on the business you're going to look at, certain items will be included in certain categories. So the costs that we're going to discuss are, again, taken at a high level. We have broken them down into variable costs and fixed costs. Variable costs are basically cost of sales, and your fixed costs are essentially your operating expenses. Now, in regards to your variable costs, there's two approaches to calculation. Basically, if you have the information, you can break everything down by item. Now, if management provides this information, you have a much easier job of doing this. However, if you don't, and you're only able to assume your volumes and your essentially cost per unit, then that will be one approach. But again, in regards to cost per unit, these should also be increasing by inflation. And if you don't have the information, like you normally wouldn't for public companies, you can essentially forecast this item as a percentage of revenue. And this is typically the standard to do that. Now, the other thing I want to talk about are your operating costs. Now, again, if you have the information from management, use that information because you have a much more detailed breakdown. However, if you don't, a practical rule of thumb is to take your just apply a percentage of revenue in line with historicals. So if you are expecting the business to be improving in its efficiency, then you might want to keep that percentage down in the forecast. However, if you don't know, then you will have to make what you can with it. The one thing I want to talk about in regards to variable costs is these volumes. If you're going to be following the volumes by price cost per unit approach, should be linked to your revenue. Okay, this is just something to keep in mind. And also, don't forget inflation. Costs increase over time, just like everything else. Now, talking about capital expenditures and depreciation. So this is a very, very important topic, especially for private businesses, because typically private businesses will need this, will rely heavily on this for growth. Not that public businesses don't, but the large expansion is important for private businesses. Anyways, I want to talk about additions really quickly. Additions being capital expenditures. So there's essentially two forms of capital expenditures that you should keep in mind, either planned CapEx or maintenance CapEx. Your planned CapEx is for expansion. This is what management has basically included in their business plan. Maintenance CapEx is the smaller CapEx that's used to maintain the fixed assets. Now, if you have the information, use it. If you don't have the information, then you need to make an assumption. And basically, the assumption that you can make that's used as a rule of thumb is to keep your capital expenditures in line with revenues. So basically, take a percentage of historically of what capital expenditures were in relation to revenue and carry that forward. And if you remember, we just discussed how CapEx essentially drives that revenue growth. Now, there's a couple of ways that you can depreciate revenue or depreciate your capital expenditures and your fixed assets, and that's either through a straight line or accelerated or units of production method. You need to decide what that is. Management will usually provide that, and they should be providing that, so you can figure out what they are using. Traditionally, at least in this part of the world, straight line is most commonly used, and that just makes things much easier. Now, in terms of how far you want to depreciate the asset, I would just conservatively assume that you're depreciating the asset to zero. You don't want to overstate what the fully depreciated asset would cost at the end of its life. Now, existing depreciation and new depreciation should be broken down separately. The existing depreciation should be based on the last year's depreciation based on its net book value, and the useful life should be figured out that way. However, for new depreciation, all new capital expenditures should be depreciated on their own. So these two categories should basically be summed up at the end. Now, the same process should be used for intangible assets and amortization because they are treated in the same way. Now, in regards to working capital, basically, you should be using the days formula for your accounts receivable, your inventory, and your accounts payables. This is your DSO, your days sales outstanding, your DIO, your days inventory outstanding, and your DPO, your days payables outstanding. Now, regarding your other assets and other liabilities, you can use some form of days formula. However, you can also just take these two items as a percentage of either your cost of sales or your operating expenses. Now, it makes more sense to link these to your operating expenses. However, it is completely dependent on how the business measures these items. Depending on what actually is included in your other assets and your other liabilities, that's what you should be using as a base. So you need to basically identify what is included in these items and use the appropriate income statement item to calculate the ratio. So in regards to your days per year, we recommend, as does the FMI, the Financial Modeling Institute, that you use actual days per year. This just makes things much more accurate. However, using 360 or 365 days is also fine. It really just depends on what you decide to do with this business plan, but you need to be consistent. So don't arbitrarily decide to use 360 days in 1 year and then the actual days in another year. So just be consistent, and this goes for every single schedule in the model. Now, income taxes, I'm not going to say much here because we don't really sensitize much. We just follow the reduction in timing difference and deferred income tax method. Now, the one thing I want to talk about is zakah. In the GCC, we have something called zakah, which is essentially taxes, or it's used in place of tax. For this, you can either create a full zakat schedule, or you can just follow the 2.5% of earnings before taxes method. Now, this is more commonly used because unless you are actually a zakah or tax consultant here, you will not, you will have a tough time, I should say, trying to create the proper schedule. So I just recommend that you use this 2.5% of earnings before taxes. Now, in regards to debt and interest expense, so there is, for each layer of debt, you should create a debt schedule. You want to use the historical balance in order to calculate or to assume the debt payments going forward. And you should be using a interest expense that's separate from the debt schedule in terms of modeling. Now, you should include a revolver. You should always include a revolver, because this will allow you to identify when the business is actually going to be cash negative. If it's cash flow negative or total cash negative, it will need a capital injection. And this will help you determine when you might need to approach a bank for additional financing or approach an investor for additional capital. Something to keep in mind is circularity. Now, if you know how to use macros, you can go ahead and do that, because what the macro will do is it will avoid causing a circular reference. I don't want to get into detail about it here, but if you've ever dealt with a circular reference before, then you know how much of a struggle it is, or it can be, to resolve. So I prefer just to use the opening balance when constructing your debt schedule. However, if you feel fine creating a macro, go ahead. I would just recommend, if the model, that if it's a small model, to go ahead and do that. However, if it's a large model, it might eventually break your model. It might slow your model down too much. So again, we'll keep that completely up to you. And now, in regards to shareholders' equity, just a couple things I want to highlight. In regards to common shares or additional shares, you need to determine the timing of the additional capital, when additional investors will come in, and the timing of dividends. And you also need to determine if the dividends will be based on revenue, based on net income, or if there's a fixed dividend plan that management has previously announced or plans to distribute. Again, just a couple of rules of thumb to keep in mind. You should always create a summary sheet. This should always be included in every business plan and every set of financial statement forecasts, because it allows the user, or not just the user, but those who will be looking over the model, to basically see every key piece of information highlighted. Regarding the income statement, this would be essentially revenue growth, your EBITDA margins, net income growth, and margins. If there are other key assumptions relating to the business you are forecasting, then of course include them. If there's things like units sold, if that's a very important item to analyze and scrutinize and into the details, and yes, include it. Maybe staff, depending if you're a staffing agency or a consulting firm, things like that. In regards to balance sheet, it's the traditional current, non-current assets and liabilities, as well as any fixed assets and long-term debts. In regards to your cash flow statements, your three main cash flow categories: operations, investing, and financing totals, as well as your capital expenditures and free cash flow to the firm and equity. Something to keep in mind here, you just want to highlight the key pieces that are most relevant to your business. So for every business, it will be different, and you will just need to highlight what's important for you. Now, in regards to scenarios, you should always have more than one scenario. The first scenario is always the base scenario, and this is the essentially consensus view. If you're looking at a public company, this would be the consensus. If you're looking at a private company, this would be management's assumptions. Okay. Now, when you create and this can also be the best case. If you feel, based on your study, based on your analysis of the industry and of the business, that they are being too optimistic, this can be the best case. Typically, it's not going to be the worst case, but usually in practice, it is the best case. Now, in our example, we're just going to call it the base case because that's what it is. But you should always include a downside case or a worst case. The percentage that you want to reduce certain items, key items, the drivers of the business of the forecasts are completely up to you. It's going to depend on your research and your confidence in certain assumptions that have been highlighted. But again, that's going to be on a case-by-case basis. Basically, you want to incorporate these few assumptions, these few key sensitized assumptions into your model. Now, you need to keep in mind when you create your scenarios, you should create it last, but keep in mind what items you're going to be sensitizing as you construct the plan, as you construct the financial forecasts. Some things that you can sensitize that are easy to sensitize are the inflation rate, because this links under at least 3 categories, from revenue to operating costs and cost of sales. Your sales volumes growth rate, maybe you want to sensitize that downwards or upwards, and sales price. This will typically have the largest impact. Also, your capital expenditures, or if you have a breakout of your capital expenditures, maybe units of vehicles purchased, or some sort of breakout from there. Again, this can be anything, but it's going to be what you determine to be the main driver behind the business. Now, linking your assumptions is linking your scenarios is a relatively easy task, and that's why I suggest saving it for last. It's probably the easiest part of creating creating your forecasts, at least in the modeling perspective. And there's a couple ways to do it. You can use the choose function or the index function. Now, just a couple of questions you want to keep in mind as you model. You should always sense check. You need to determine whether your assumptions are realistic. Okay. If you ask for assumptions, you will most likely get, you will get assumptions. Now, if they are realistic, I don't know. You will need to always check the assumptions you've been provided to determine whether they are realistic. And lastly, you need to determine whether your outputs make sense. And this will help you in terms of the modeling aspect to make sure you didn't mess up any calculations, and also that the business plan makes sense. If the something to keep in mind is if management plans to expand in multiple continents, and it's expected that they will be operating at a loss for the first 3 years because there's so much investment going into these 3 new continents, and your forecasts basically say that you're actually making twice as much revenue. Well, clearly there's something wrong there, right? Or you're twice as much profit, then clearly there's something wrong there. Always sense check. And you should be sense checking as you complete each schedule. You don't need to wait till the end, but you should also have a complete sense check at the end. So I have a simple model for us. I just want to go ahead and create. Now, this is the business we've been provided. It is called Virginia Global. What I would like to do is I just have a few assumptions I would like for us to create together. So we have basically the horizontal approach of model construction, and we have our model here. Now, everything is linked, so all we need to do together is to basically fill out the assumptions. Now, there's a few assumptions on some of these sheets, of some of the working sheets. We'll go through them together, but we will go ahead and see the output of our business plan once we've completed. We also have a valuation sheet and a summary page that we can take a look at once our business plan has been completed. Now, we don't want to look at the valuation first and try to reverse engineer a value. So we're just going to work starting with the revenue. Yeah. So it looks like I have a comment here. Please determine an appropriate revenue rate, a growth rate based on the historical financial statements. So let's take a look at now this is asking for revenue volumes. Now, I don't have a historical revenue volumes here, but I can take a look at my historical revenue and I can see what the growth rate has been. So it was 16% or 17% in 18, and then it dropped to 12% in 19. So how about if it was roughly 12% last year, I can assume that maybe, revenue is going to decline like this. It's going to just be trending downwards. Maybe the business has been is peaking. I don't know, but just extrapolating from the historicals, this intuitively makes sense. Now let's take a look at let's go to our next section, costs. So we have here, they're asking us to determine the appropriate distribution of costs. So the way that this model has been structured, and this is a pretty high level model, is we have our total cost, and our costs have been allocated between variable costs and fixed costs, basically cost of sales and OPEX. And the distribution is here. So historically, it was 25% and 75% for fixed costs. And you know what? We'll just keep it the same. I have no reason to assume, why one would be higher than the other, especially since they're all being based off of total cost. So this is the total cost, simply annual sales volumes times cost per unit. And that's encompassing all of the costs. This includes SG&A, OPEX, everything, marketing, cost per unit. This is the total cost. So I have no reason to change or to play with this range. I'll just leave it as is. Let's go to working capital. All right, let's see here. Please determine the appropriate working capital days and percentages. Now, again, I don't have all of the information. I haven't sat with management, but I am simply extrapolating everything from my historical performance. Now, if I'm going to try to determine my working capital, what I can do is I can simply take an average of what's been going on historically, or if there's a trend, I can try to extrapolate that trend. Now, if I look at the 3-year historical for accounts receivable, it doesn't look like there's a trend. It looks like it dipped from 31 days to 22 days between 17 and 18, but then it increased to 27 days in 19. And it looks like that has actually been the case for all 3 primary working capital items. And it looks like it's also the case for our other current assets and liabilities. So I'm going to make it easy on myself, and I'm just going to take the average of the 3 years. And I will do that for all of the working capital assumptions. And I will simply keep it as is. Now you can see my working capital has filled out, and it seems to make sense. It's essentially taking an average of those 3-year historicals, and I'm going to carry that assumption forward. Now, if I'm able to sit with management and I can understand their working capital, rules in regards to their accounts receivable plan, their credit policies, their inventory management system, I can make much better forecasts. However, for this example, we'll just use an average. Now, in taxes, doesn't seem like there's anything there. In regards to CapEx, let's see. So in regards to fixed asset additions, management plans on making CapEx of $2.5 million over the next 5 years. Please allocate appropriately. Now, they didn't give us any further details other than the fact that they expect to make additions of $2.5 million. So if we keep this simple, we can just say that they are going to be adding $500,000 a year. I think that makes sense, and I'm pretty sure that totals $2.5 million. And if we sum it up, it does. So let's see what's going on with the intangibles. So in regards to intangibles, management plans on making CapEx of $50,000 a year over the next 5 years. Okay, so what we're going to do is we're just going to follow what management has highlighted for us. And as you can see here, the entire capital expenditures below schedules are already constructed, everything down to depreciation. You can see now why it's easier to have everything broken down on its own sheet. It's just much easier to work with. Okay, let's come and look at our debt. What's going on with debt? Loan additions. Management plans on issuing $50,000 sometime over the next 3 years. Well, I don't know what that means, but if I want to make it easy on myself, and again, I am taking the easy route here. Ideally, I will want to sit with management, and I will want to know when these items will take place, because these will affect cash flow, they will affect valuation, they will affect a lot of things. But for this case, for the simplified approach, I'm just going to spread things or distribute things out evenly. So management also plans on repaying $40,000 over the next 5 years. Please plan appropriately. So $40,000 divided by 5 is 8,000, and I will just carry that forward. So they plan on repaying $8,000 a year, and they are borrowing $10,000 a year. This is a really weird debt schedule that they have planned, but you know what? We're not going to question it. Let's check out the variable rate debt. What's going on here? Management plans on repaying $5,000 a year. Please allocate appropriately. Okay, simple. They just plan on paying out or repaying $5,000 a year in regards to their variable rate. Wonderful. And it seems that the revolver is already calculated. Thankfully, it doesn't look like we will be pooling on a revolver. Otherwise, the schedule would be filling out already. So now let's take a look at our equity. In regards to equity, management plans on repurchasing $120,000 of common stock over the next 4 out of 5 years. So 120,000 equals 30,000 a year. So I'll just start in 2021 and carry that forward. 2020 will keep a 0, but let's just ensure this equals $120,000, and it does. Let's take a look at common dividends. So what are common dividends going to be? What's the plan? Management plans on paying dividends of 25% for the next 2 years, then 40% for the remaining years. So we'll just simply include 25%, and then we will make our dividend payments 40%. And you can see the schedule below has captured all of that. All right, now let's take a look at our financial statements and see what the situation is. So it looks like revenue has increased from just over $10 million in 2019 to $14 million in 2024, whereas net income has increased from roughly $1,073,000 to 1.4 nearly million. That's great. That's great. It looks like we lost a bit in our margins in terms of net income. However, our revenue didn't actually grow at what we thought it did. It grew a bit more. We'll have to take a look at it and see why this happened, and see what's going on with our revenue situation. But let's move on to our balance sheet. Our total equity has increased basically from 3.7 million to 7.9 million, resulting in a cash increase of 2.7 to $5 million. This is great. This looks like a great business, yeah. And it looks like we still have barely any debt, regardless of the fact that we were increasing our debts by $10,000 a year. Our debt to equity is still, a rounding error essentially. Now let's look at our cash flow. So it looks like over the next 5 years, our cash balance increases from 2.7 million to $5 million. This sounds like a wonderful business, and it looks like it's paying out huge sums of dividends. So over the next 5 years, we're basically paying out just over $2 million in common dividends. Man, this sounds like a wonderful business. I should see if we could get a share in it. Now let's just take a look at our summary sheet really quickly. Our summary sheet is going to highlight those key items that we discussed. If you look at the income statement, we have revenue, EBITDA, and net income, and the appropriate growth for each item. Our balance sheet focuses on our non-current and current items, as well as debt and fixed assets, shareholders' equity, and key ratios. Our cash flow statement focuses on our opening closing cash, our 3 cash flow categories, CapEx, and our free cash flow to the firm and equity amounts, as well as key cash flow ratios. So everything looks like it's been calculated appropriately. Let's include our scenarios now. Now it looks like it's already been created, but we have scenarios here as well. We can either increase or decrease these assumptions. So we have our base case, and we can push these items upwards or downwards. The 4 items we do have sensitized is the cost inflation, the annual volumes growth rate, our other revenues growth rate, and cost of sales distribution. Now, these were, for this example, created completely arbitrarily. However, depending on your business, you should look for those key items that will have the greatest impact on your business. So let's just head over to our summary page and just see what will happen if we change the scenario to the best case. So if I change the scenario to the best case, it seems that my EBITDA and essentially everything went up in the right way. So if I flip through and I look at EBITDA and net income, EBITDA in year 5 in 2024 goes from 2.4 million. Well, it gained about $500,000, right? So it went from 2.3 to 2.4, or gained $50,000. Sorry. And if we decrease it, it heads down to 2.3. All right. And we can essentially sensitize each sheet because this drop down menu is on each sheet, so we can see what's going on each one of our working schedules if we choose to. And now we can basically analyze our valuation. Again, this is a completely made up company. There's no real, nothing real in regards to these financials. These were completely made up for this example. But it looks like our business, based on our assumptions, is worth roughly, well, this is the worst case, but let's go back to the base case. It's worth roughly $12 million. If we cycle through to our best case, wow, it became so large that it doesn't even fit on the page anymore. It increases to $12.3 million, and worst case drops down to 11.9. Now it looks like we weren't being too extreme in our scenarios, but they do have an impact. Now this is pretty much all I have. If you have any questions, please ask them now. But I hope that you were able to see or gain some insight into how to create financial forecasts. As you can tell, financial forecasting is essentially an extension of financial modeling. I hope that this was enjoyable for you. I hope you're able to take something away from it. And I wish you the best of luck with your financial forecasts and with whatever you have going on. Thank you. If you have any questions, I'm here. Otherwise, that's all I have for you today. So we received a question asking if there's another webinar about this topic. We will have webinars in the future regarding forecasting, financial modeling, planning, budgeting, all of these things. Please check our website at viftraining.com for updates. Please register for our mailing list. If you are interested in this topic in particular, we do offer financial forecasting, budgeting, and planning as a course. We do also offer financial modeling courses through virtual live as well as e-learnings. So please check out our website if you are interested. However, this is all we have for today.